Very good morning, friends. So I hope you're all doing good. And most importantly, I hope you made a revision of what we did yesterday. So we started the foundations of financial instruments with you yesterday. And just to give you a quick recap and take the journey forward, I had given you the insight in terms of when you look at a financial instrument, the most important aspect is the presence of a contract. There has to be a contract between the two parties, and one is called the issuer and the other is called the holder. So when you look at an instrument from the issuer point of view, you are looking at the liability side of the balance sheet. We need to take a call whether it is to be presented as an equity or as a financial liability. And I think now I can also add that whether it's a compound financial instrument. So the issuer needs to decide the presentation on the liability side of the balance sheet. Is the instrument equity instrument? Is it a financial liability, or is it supposed to be a compound financial instrument? But in all these cases, if you look at the perception of the holder, he will always land up saying it's a financial asset. And for the purpose of deciding whether instrument is either equity or FL or a CFI, I gave you a simple three-step model, and with the help of which we decided the instrument is going to be categorized under which category. Just to take a quick recap of the three-step model which I gave you the inputs that you are going to first focus on step number 1. There needs to be an obligation which is contractual in nature. Now, when you say it is contractual in nature, let me remind you that contractual obligation is just one element of the legal obligation. When we use the word legal obligation, it is by virtue of law or it is by way of contract. But the focus in terms of financial instrument is it needs to be contractual in nature, not legal, not by law, but just contract. The second focus came in terms of how you are going to discharge that obligation. And we said basically there are got two modes of payment. A company, while discharging its obligation, could use the normal currency, which is cash, or it could land up using, you can say, its own equity share as a currency note. Now, when you consider the cash as a mode of payment, you need to be cautious. I gave you a version number 2 in which I introduced that you need to see that there has to be an unavoidable payment in cash. The main focus point is that if the mode of payment is cash, you need to have an unavoidable payment in cash. So we need to look at words like mandatory or discretionary in terms of return. We need to focus in terms of redeemable or irredeemable in terms of the principal repayment. And accordingly, we decide, is it a financial liability or is it an equity? And that also we are deciding for each component of the obligation. But if the mode of payment is shares, we go to the step number 3, and let me also add another name today. We are considering what is called a fixed test. When you start looking at the step number 3 and you start looking at is the number of shares to be issued, is that fixed or variable in nature, technically it is called a fixed test. So when the number of shares to be issued to settle the obligation is fixed, predetermined in number, it becomes an equity instrument. And if it is variable, then it becomes a financial liability. So basically, when the mode of payment is cash, your mind should trigger in terms of mandatory, discretionary, redeemable, irredeemable in nature. And when you start looking in terms of the mode of payment being shares, your mind should focus in terms of fixed and variable in nature. So we did a couple of illustrations, and I made a total of 3 charts also with you, wherein I gave you the different permutation combinations that when the mode of payment is cash, chart number 1, when the mode of payment is supposed to be shares, that is chart number 2, and then I gave you the chart number 3 where the mode of payment is both in terms of cash as well as shares. Then I introduced you something and I said that my discussion is being concentrated only in terms of instruments which are non-derivative in nature. I am now going to start off with a little technical discussions in the morning. So I think it's a good time to start early in the morning and also do some technical stuff discussion. So I'll go slow on it because what I'm going to discuss in the next almost 1 hour with you is going to be slightly technical in nature, but trust me, it's going to be very interesting at the same time. So I think let's begin the journey and let me just remind you the 3 kind of instruments. I know I need to give you some insights on what are derivatives as well. I'll give you some inputs on derivatives as well and introduce you the concept of derivative and embedded derivative instruments. So get ready for some technical stuff at this stage. So I also made a mention yesterday as well, and I'm just going to make the same statement once again. Now, if I am looking at financial instruments from the point of view of the issuer, let me tell you, my focus is on the issuer. I will be coming to the focus in terms of holder later. Typically, when I come to Ind AS 109, I'll start making a focus first on the holder's perspective. But right now, our entire focus perception is from the issuer perspective. Now, when you look at a financial instrument from the issuer perspective, I would say there are basically 3 types of instruments. I would put it like this, that there are 3 types of instruments, not the classification. Not that I'm looking at it as FL, CFI or equity instrument, but we're looking at it is supposed to be a pure non-derivative instrument. I know unless we understand what is a derivative, it is difficult to appreciate that what is a non-derivative instruments. So no worry, we will understand what is a derivative. The second is that it becomes a pure derivative instruments. And the third kind of instrument is a blended one, which is supposed to be, you can say, a derivative plus a non-derivative. So there is both a derivative element in the instrument and there is also a non-derivative element in the instrument as well. Well, technically speaking, the third category, which is a blend of a derivative as well as a non-derivative instrument, is technically called that there is what we call an embedded derivative. There is what we call an embedded derivative in the financial instruments. Now, we will be talking about embedded derivatives later as well when we come to the concept of Ind AS 109. So almost towards the last leg of the standard, we will also make a discussion with reference to embedded derivatives separately. Right now, my focus is not going to be much on the third category. My focus, yes, I will be discussing a bit of it, but my focus will be to first explain you what is supposed to be a derivative. So remember, when you're looking at an instrument from a macro point of view, before you say that, it is supposed to be, a financial liability, equity, or a CFI, I am first of all also trying to look into the picture that is it an instrument which is purely non-derivative in nature, purely derivative in nature, or a blend of a derivative and a non-derivative in nature. So I think the very first question what comes to the mind is that what is supposed to be a derivative? So I think my first focus point is in terms of understanding what is a derivative. So I presume that you may have some basic knowledge on a derivative, but I think let me explain from the basics, because many of you said that we are not very comfortable with the idea of what exactly is a derivative. So I am going to give you exposure on the concept of derivative only to the extent it is required for financial reporting. I am not going to take you too much deep in terms of derivative instruments, but only to the extent we need an understanding for financial reporting for financial instruments. So let's, I think, discuss the concept of what is a derivative. I'll take a very simple example to illustrate the concept of a derivative to you. Though it's a very basic example only to understand what a derivative is, I may not be able to apply all the essential features of a derivative. You heard me correct. Before you call an instrument to be a derivative, we need to fulfill certain parameters. And there are a total of 3 parameters. But I'll not directly jump to those 3 parameters, but let's first understand a very basic element of what is a derivative. Let's take a very simple example. Let's say, for example, I always tell people that let's say I buy a movie ticket in the PVR cinema. Let's say I go to buy a movie ticket in PVR cinema. And let's say if I want to buy a ticket, let's say the price of the ticket is, let's say 500 rupees. Now, what does this mean? This technically means that you are going to pay 500 rupees of cash and you will get a ticket. So there will be a physical settlement. I'm using a little technical words because I want to reach the concept of a derivative. So I'm just taking a very simple example. I go to the PVR cinema and in this particular case, I pay 500 rupees in cash and I get a physical ticket with which I can watch a movie. Now imagine on the other hand, let's say for example, on the other hand, I am able to get, let's say, a PVR pass. Somebody passes me a PVR pass, which also entitles me to watch the movie with the help of the pass. Now, generally, when you're given a pass, it is very clearly mentioned that it is not transferable. But let's assume for the purpose of understanding that it is very clearly written on the pass that it is transferable. It can be transferred. If you want, you can transfer this pass to anybody. Now, I want to first of all understand that if this pass is something which can be sold, if this pass is something which can be transferred to another party, what is the price at which I will be able to sell this pass? Let's assume that this PVR ticket is available for 500, but at the moment, the movie is a big hit. Let's say you're watching a movie, the latest one, which is Pushpa 2. So let's say, for example, in this particular case, the movie ticket is not available. People are not able to get a ticket. But I have this PVR pass with me and somebody wants to buy that pass from me. Would you like to tell me what is the minimum price at which you will be able to sell this particular pass? Consider the facts which I gave you. And I gave you the facts that in this particular case, the movie is a big hit and the tickets are not available on the counter. So when the tickets are not available on the counter, I've got the pass. What is the minimum price at which I will be able to sell this PVR pass at? And that's rightly said. I will be able to sell this pass at a minimum price of at least 500 rupees. And where did you get this 500 rupees from? You got this 500 rupees from the ticket price itself. So I think it's the right time to tell you one particular input that we can say the PVR pass is supposed to be deriving its price. I can say it is deriving its price from the PVR ticket itself. I think as a logical flow, I can definitely say that my PVR pass is not having an independent value, but it definitely obtains a value ultimately, but it is deriving its value from the PVR ticket itself. So this is one of the most important features of a derivative instrument. The word derivative comes from the English word that is derives. Why do we call it as a derivative? Because the instrument is supposed to be deriving its value from what we call an underlying asset. So to put it in a technical words, from this example, if somebody were to say that, okay, tell me in simple words, what is a derivative instrument or what is a derivative contract? I'm using my words very carefully. I'm saying a derivative instrument, or we are saying it is supposed to be a derivative contract. A derivative could be a contract, a derivative could be an instrument as well. So what is the most important element of a derivative contract? We can say the feature number one. We can say the feature number one is it derives its value. It derives its value from an underlying asset. It derives its value from an underlying asset. And let's underline the word underlying asset. So in my example, I can very clearly say that the PVR pass is deriving its value from the PVR ticket that is called the underlying asset. So once the instrument is able to fulfill the feature number one, I would say it is going to be a derivative instrument. But let me cautious this and tell you that there is not one, but there are three features or three characteristics which you need to meet. If you want to call a particular instrument as a derivative instrument, you need to fulfill the feature number one, and there are two more features which I need to fulfill. But before I give you the feature number 2 and 3, at least I can use the name of certain common types of derivative instruments. I'll give you a basic feel of each categories as well. But I can definitely, before I go to the more features at this stage, let me give you what are the most common examples. Let's understand what is the most common examples of instruments which are supposed to be derivative in nature. And we can say one is called a forward contract. One is called a futures contract. One is called options contract. And there is also what we call swaps. That is also another kind of derivative contract. So they're basically, you can say, four most common kind of examples of derivative contract: forwards, futures, options, as well as swap contract. I'm getting a little feeling in the morning that I am perhaps teaching you advanced financial management instead of financial reporting, where I'm talking in terms of derivatives and telling you that what is the features of derivative. But as I said, the idea is only to give you an exposure, so that we can get a better understanding of financial instruments. So I'm going to give you inputs to the extent it is required for my purposes in financial instruments. The idea is not to make you any experts on derivatives. The basic knowledge is required. Right. So I think this is one inputs. I hope I stand very clear on this particular aspect. Now, before we go on to understanding of what is a forward or a future option, I'll not get into swaps at the moment, but I'll definitely give you some basic understanding of what is a forward, what is a futures, and what is an option contract. But before we get into these three, let's also understand more features of a derivative instrument. So let's go ahead and let's understand what are the features of a derivative instrument. So when you look at the features of a derivative, as I've already said, that there are a total of three features before you can call the instrument as a derivative. The first feature you've already seen, that the value the instrument derives is from an underlying asset. Now, let's consider the second and the third feature as well. So I think let me first put down the first feature, which I've already given to you. So the first feature is that it derives its value. It derives its value from an underlying asset. It derives its value from an underlying asset. So this is the first feature which you need to fulfill, that it getting its value derived from an underlying asset. Now we'll see examples when we come to forwards, futures, and options. We will have a look at, what is the underlying asset through which the value is getting derived. Now, the feature number 2. There is nil, or there is what we call negligible. There is nil, or what we call a negligible investment at time 0. So I'm putting it as T0. So there is a nil, or we can say a negligible investment at time 0. Now, when you enter into a derivative contract, I would say that is the time zero. When you enter into a contract that is a time zero, the investment made at that stage is either zero or it is negligible as compared to the overall contract price. We'll be able to understand this better when we come to forwards, futures, and option. But let me take another example as well, which many of you would easily relate. Let's say, for example, a company issues a share warrant. Now, many of you would say, what exactly is a share warrant? Well, I would say when a company issues a share warrant, it is given to the existing equity shareholders of the company. And in terms of this share warrant, you tell the existing shareholders that if you want to buy more shares in the future, you can buy them through the share warrants. So the company gives the equity shareholders, their existing equity shareholders, a share warrant which entitles the option on the part of the shareholders to buy shares at a future date at a predetermined price. Now, when the share warrant is given to the shareholders, then there is no investment which is made by the shareholders at that stage. The consideration for acquiring shares will be paid at a future date. So there is no investment which is made at time zero. So which means that once the contract is entered into, once the instrument is issued, there should be practically either zero investment or a very nominal amount of investment is made at that stage. And the third feature is that in this particular case, there will be a settlement at a future date. There will be a settlement at a future date. The contract is entered into today, but the settlement is going to be done at a future date. And I think it is necessary to emphasize one particular point at this stage. If you want to call an instrument as a derivative, you need to meet all these three conditions. Even if any one of the conditions fails, the instrument cannot be called as a derivative instrument. So I think let me put this point blank at this stage that you need to meet all the features. You need to meet all three parameters. Even if a single parameter is not met, it is not called as a derivative instrument. So you need to meet all the three into this. Okay, I got a question. Did bonus shares will also be covered here because company announces a bonus and then I purchase the bonus? Well, you can't call a bonus as a case of a derivative instrument because bonus in this particular case is hand to hand settled. It's and you don't need to pay any consideration either. They are supposed to be not a case of derivative instruments. Derivative instruments mainly would be comprising of instruments which will have a span of settlement over a period of time. And in this particular case, when you look at a bonus issue, the shareholder is not supposed to pay any consideration. He is simply getting the shares free of cost. So you can't meet the parameters of a derivative. So no, it cannot be, right? Okay, so coming back to the point, as we said, that if you need to call any instrument or any contract in as a derivative instrument, fulfill all the three parameters. Number one, you prove that the value of that instrument or the contract is being derived from an underlying asset. You prove the fact that there is zero or negligible investment at the time of entering the contract, and the settlement is going to be done at a future date. All conditions met, it's called a derivative. I think now let's come back to those common examples of derivative instruments. Let's have a little input on a forward, a futures, and an option contract as well. So let's take you further and let's come to the common examples of derivative instruments. I'm going to first of all take my discussions with reference to what is called a forward contract. Now, at this stage, it is also important to give you some inputs more. When you're looking at a derivative market, when you're looking at entering into a derivative contract or instruments, you can say basically we're looking at a derivative market. So the place where which the derivative instruments are going to be dealt with, you can say they are basically a derivative market. Now, as far as a derivative market is concerned, whether it's a forward or it's a future or it's an option contract, you could deal in terms of currency, you could deal in terms of commodities, you can deal in terms of shares, you could deal in terms of even interest. For example, if you ask me a forward contract, I would say mainly, I'm not saying only, I'm saying mainly forward contracts will be entered into when you enter into currencies. I'll take an example when I explain the concept of a forward contract, which is going to be essentially that I am an importer or I am an exporter and I need to buy or sell a foreign currency. So I might enter into contracts which are forward in nature. But as I take the example, let me caution you that when I say a forward contract is not limited to only currency. As I said, in a derivative market, you could enter into currency contracts, you could enter into commodity contracts, you could enter into share contracts, that is stock, that is buying shares of a company, or you could even enter into interest rate contracts as well. Like for example, we can have a forward rate agreements for interest. Similarly, when you enter into futures contract as well, it could be for the purpose of shares, it could be for the purpose of interest, or for the purpose of commodities as well. But for the ease of understanding, as I take examples, when I'll explain you the concept of a forward contract, I'll take currency as a base. When I'll explain, for example, the concept of a futures contract, I will explain you the example of a share market. And as I explain the concept of option contract again, I'll take an example in terms of a share market itself. So please do not get confused on the agenda that when I take an example on a forward contract and I take currency as an example, don't feel that forward contract is only limited to currencies. So in order to explain, I will pick up either currencies to explain the concept, or I will pick up the shares in order to explain the concept. But as I said, whether it is a forward or it is a futures or it is an option, you could enter into either commodities or share market, or it could be currencies, or it could be in terms of interest rates as well. Let's now begin the journey in terms of a forward contract. Now, as I said, in order to understand the concept of a forward contract, let's consider currency as a base. Let's consider the foreign currency as a base. So let's take a very simple example. Let's say, for example, I am an importer. Now watch this carefully. This is just to give you a very basic idea of what is a forward contract. And all this understanding will also help us a lot when we go to India's 109. And in the last leg of the standard, I will be discussing the concept of hedge accounting. So I will remind you that, in the initial classes, I've already given you the concept of what a derivative is. So at that stage, we don't have to revisit and tell you that what is a forward, a futures, an option contract. We'll simply say, what a derivative is. So imagine that I am an importer. And let's say I am an importer, but I am in India at the moment and I want to buy something. I need to buy something in USA. And this is going to be, let's say, 6 months later. So let's say, for example, I am an importer based in India and I want to buy something in USA, let's say after a period of 6 months. Now, as an importer, I am apprehensive that the exchange rates will change, in the sense that, let's say, for example, the exchange rate today, let's assume that the exchange rate today, let's say $1 is, let's say, equal to 70 Indian rupees. I'm not taking the current exchange rate. I'm just taking an example. So don't judge me on the fact that I've taken a 70 exchange rate. It's just an example. So let's consider that I know the exchange rate today, $1 is 70 rupees, and there is an expectation and there is an expectations, I'm expecting that after a period of 6 months, the exchange rate will drastically move and it will move to, let's say, 80 rupees a dollar. Now, as an importer, I know that if the exchange rate goes up, I will have to pay more Indian rupees in order to buy the item. I think let me put this again. Since I want to buy something in USA, let's assume I want to buy something in USA, which is to the extent of, let's say, $1 lakh. So if you want to buy something in USA, which is to the extent of $1 lakh, I know that if I buy this item today, I will shell out 70 lakh Indian rupee. Because $1 is 70 Indian rupee, so I will shell out 70 lakhs today. But if I am going to pay this money 6 months later, my total outflow is going to be 80 lakh Indian rupees. So as an importer, I am very worried. So what I do in this particular case, I am going to approach the bank today. I know that I want to buy things 6 months later, but as an importer, I would approach a bank today and I'll tell them, sir, I need to buy a foreign currency 6 months later. Can you enter into a contract with me today? Mind the words. I'll say, okay, can you enter into a contract with me today and you give me a predetermined rate? You tell me the rate at which I will be able to buy dollars at the end of 6 months. And the bankers will say, yes, we've got something for you, which is called a forward contract, which you can enter into today and not make any kind of payments, and it can be settled at a future date. I'm using my language very carefully because I want to bring out the features of a derivative contract. So the banker tells me that yes, you can enter into a contract today and you just need to sign a contract, and in this particular case, no payments are required today. But you need to definitely honor this contract at the end of 6 months. So in this particular case, the bank today tells me that you can enter into a forward contract with me today. And they say that yes, you can enter into a forward contract and we can tell you that $1 we are going to give you, let's say, at the rate of 76 rupees a dollar. So the banker tells me that yes, enter the contract today, and we tell you that you can come after 6 months and pay us 76 rupees a dollar and you can buy dollars. So now let me ask you something. My question number one in this particular case is this forward contract dependent upon the currency exchange rates prevailing as of today? If the banker is also able to give you a forward rate today, is this depending upon the movement of the currencies which is happening in the spot market today? I would say yes. Is there any kind of investments I need to make at time zero? I would say no. And is the settlement going to be done at a future date, which is another 6 months? I would say yes. So I would say this forward contract is supposed to be something which we can say is a pure derivative contract. It meets all the three elements of a derivative instrument. Number one, it is deriving its value from the currency rates. Number two, there is no investment at time zero. And number three, in this particular case, the settlement is going to be done at a future date. So this is a derivative contract. Now, I think for your knowledge, I would also like to tell you two more simple little things which we can keep in mind. Number one, the first input which I want to give you about a forward contract is that number one, it is supposed to be, you can say OTC. Number one, we can say that it is OTC, that is called over the counter. Like for example, when you buy shares in the stock exchange, it is called exchange traded. There is a separate exchange where you can buy and sell shares. You go to the Bombay Stock Exchange, you can buy and sell shares. It is called exchange traded. But when you enter into forward contracts, they are not exchange traded, they are over the counter. When I say over the counter, it means you go to the bank and you change the currency over the counter. So it is called over the counter. They are not exchange traded. So this is for your knowledge that they are not exchange traded. There is no exchange in which they are traded. Like for example, the shares are traded on a stock exchange. So we say they are not traded in exchanges, but it is called OTC, over the counter. The second important element what I want to also feature out is, if you enter into a forward contract, there is no exit. If the company enters into a forward contract, it always reminds me the famous dialogue of the Bollywood, personality Salman Khan, which says, "एक बार जो commitment कर दी, उसके बाद तो मैं अपने आप की नहीं सुनता." So I always say that a forward contract is more like a Salman Khan kind of a dialogue, where you have entered into the contract to buy dollars at 76. In this particular case, you'll have to buy dollars at 76 itself. There is no escape route which is available. You need to honor the contract. It cannot happen at a later stage that, let's say, the dollar after 6 months turns out to be, let's say, 72. You cannot go back to the bankers, "Sir, I've changed my mood. I don't want to buy the dollars at this stage. It's available in the market at 72. Why do I need to pay 76? The moment you enter into a forward contract, there is no exit which can happen. So in this particular case, there is no escape route. There is no escape route which is available to the party which enters into a forward contract. Once you've committed, once you've entered into a forward contract, it is your responsibility that you need to honor the contract. Yes, you may, tell the bankers, "I'm sorry, I don't want to deal," then a legal course of action will be taken against you. So there is a risk of default, but still, as a matter of principle, if a company enters into a forward contract, you need to definitely honor the contract as well. So this was the basic understanding of a forward contract, considering currencies as a base. An importer needs currency at a future date. He is apprehensive of the increase in the exchange rate, so he may enter into forward contracts for the same. An exporter is going to get foreign currency at a future date, and he is apprehensive of a fall in the exchange rate, and he wants to assure a certain amount of inflow. So importers and exporters may enter into these kind of contracts in order to, you can say, ensure their outflows and also ensure their inflows. And once they enter into these kind of contracts, we say they are over the counter, not exchange traded. We call them OTC, and they are contracts where exit routes are not available. Once you enter the contract, you need to definitely honor the contracts as well. I hope, friends, I made myself clear over the concept of forward contracts. I hope I'm fairly clear with a basic understanding of what is the most common contract forward. Let's take this further, and let's also have a little understanding on the second kind of example, that is called a futures contract. Let's get the understanding of the second kind of contract, that is futures. Wonderful indeed. Okay. Now, when you are looking at a futures contract, I think the best way to understand this is a stock market. We'll take the examples of a share, we'll take the examples of stock to understand the concept of futures. So let's take the shares as a base. Just like for a forward contract, I took currency as a base, we'll consider the concept of shares. Now, I think let's understand this with a very simple example, and we're going to consider two markets in this case. So let's consider, number one, that there is, you can say, a stock exchange. I'm looking at a stock exchange. This is more like a spot market. And there is also what we can say the derivative market. There is also a derivative market, which is supposed to be a separate unit in a stock exchange. A stock exchange will have a separate unit, which is like a clearing house, where they allow people to enter into derivative contracts as well. So let's consider one is a spot market and one is a derivative market, which is definitely a separate wing of a stock exchange. Now let's imagine that as an investor, let's say I buy 1,000 shares of company XYZ Limited, and this is bought, let's say, at the rate of 120 per share. So let's say as an investor, I went to the stock exchange and I bought a total of 1,000 shares of company XYZ at the rate of 120. So what I did, I made a payment in cash and I physically bought these shares. So in this particular case, I made a payment and I physically bought these shares. Now, as an investor, I am worried that the price of the share might go down. So here I'm looking at an investor who's already invested money and he has got the fear that the prices of the share might decline. So he's got the fear that the prices will decline. So when he is fearing that the prices will decrease, he wants to enter into some kind of contracts which assures him that the drop in prices will not hit him. So now what does he do? He knows that the prices will decrease in the future. So what he does, he enters into a derivative market, and in the derivative market, he sells the futures contract. He sells the futures of company XYZ. Now, let's first understand one very basic input. As I've already said, that as far as a derivative is concerned, a derivative derives its value from the underlying asset. Mind the concept very carefully. So this is, let's say, the spot market where the share is quoted at 120. And this is a derivative market which is deriving its value from the spot market itself. So in this particular case, one thing is very clear, that the price which is prevailing in this market is getting derived from this market itself. Now, it is not necessary that if the price in the spot market is 120, the price in the derivative market would also be 120. But for understanding, mind the words, for understanding, I am assuming that let's say the price in this market is also 120. I've already given you a disclaimer. I said the prices in the future market is derived from the spot market. So it is definitely not necessary that the price in this particular market is exactly equal to the price in this market. But yes, it derives its value. It could be a slightly less than 120. It could be a little more than 120, whatever. But just for the sake of understanding, for convenience, let's assume that the price in this market is also the same. So what this investor does at time zero, he enters into a futures contract, let's say for a period of 6 months. He, let's say, enters into a future contract, let's say for a period of 6 months, where he says that I will sell 1,000 shares at the rate of 120 per share. So he enters into the contract to sell these shares at the rate of 120 per share. Now, let's see what happens. Let's assume that after a period of 6 months, let's say 6 months later, the price of the share falls to 90 rupees. Let's assume that after a period of 6 months, the prices in the spot market reduces to 90. Now remember, the price in this particular market is also derived from this market itself. So let's assume that the price in this market also turns out to be 90. As I've already said, that it is not necessary that the prices in the spot market and the derivative market is going to be equal, but I am intentionally assuming it to be same. So I'm assuming that, let's say, if the price in this market drops to 90, the price in this market also drops to 90. But I think one thing is what I want to definitely tell you. If there is a decrease in the price of the spot market, there will also be a decrease in the futures market. It is not possible that if this market prices goes up and this goes down, not possible. The direction of the price movements in both the markets will be same. Either the price in both market falls down or the price in both market goes up. The direction will always be the same. So you will see that the direction in both the markets will always be the same. So which means that if the prices pushes up in the spot market, the prices will push up in the futures market. If the prices goes down in the spot market, the prices will go down in the futures market as well. The change in the price, the delta, the change in the price in the spot market and the futures market may not match. But at the end of the day, the direction, the change is in the same direction. It goes down, it goes up in both markets, but it cannot be on the other way around, right? Now, let's understand what is the net result. He bought the share at the rate of 120 and now the share is worth 90. So can I say in this case, he has got a loss of 30 rupees per share. In this particular case, he is getting a loss of 30 rupees per share because he bought the share at 120 and now the share is worth 90. He's getting a loss of 30. But now, what do you do in the futures market? You entered into the contract to sell the futures. Now, what we need to technically do, we need to do what is called squaring off. We need to technically do what is called a squaring off, and I will take a reverse position and buy the futures in this particular market. The concept of squaring off works on this particular context that if you sell futures, then you need to take an opposite feature, that is buy futures. If you buy futures, then you need to square off the transaction by selling futures. So this is called a net settlement, that you need to take a reverse position in order to settle the transaction. So in this case, when you enter the contract to sell, now you are going to buy futures. Now see what is happening. You buy it at 90 and you sell it at 120. So you are going to get a gain to the extent of 30 rupees per share in this particular market. So indirectly, if you ask me what has happened in this particular case is you have basically been able to, what we can technically say, hedge the entire contract. Hedge in the sense that you have tried to reduce the risk which you were facing as an investor. Your losses in the spot market is compensated by the gain in the futures market, so that in this particular case, a perfect hedging has taken place. You've been able to reduce the entire loss which you suffered in this market. So this is another example of what we call a derivative contract. And let me also tell you, in this particular case, when you look at a futures contract, it is exchange traded. It is exchange traded. Unlike a forward contract, it is not over the counter. You know, in terms of a forward contract, I said it is OTC, it is over the counter. But in terms of a forward contract, it is supposed to be what is called an exchange traded, because there is a proper exchange where you are going to deal in this particular contract. So it is traded on an exchange. It is called exchange traded. Secondly, even this contract is more like the same concept. एक बार जो commitment दे दी, उसके बाद मैं अपने आप की नहीं सुन सकता. So here again, the concept of escape is not there. If you've entered into a futures contract, you need to definitely honor. So there is no escape in this case as well. So this is something common in terms of the forward contract, but otherwise the forward is OTC and this is exchange traded. So this is a simple flow of understanding how does a futures contract operate. In this particular case, again, you can say that this particular futures price is getting derived from the spot market, the feature number one. And is there any kind of initial investment? Yes, there will be. To your knowledge, let me tell you, when you enter into a futures contract, you will be required to pay some initial margin money as a safety margin to the clearinghouse as well. So unlike a forward contract where the initial investment is zero, but in terms of a future contract, you will have to pay some sort of initial margin money. So I will not say that there is no investment, but we can definitely say that there will be a negligible investment. Because in this particular case, if you ask me the contract value, you are entering into 1000 shares into 120. The total contract value is 1,20,000. So you might land up paying, let's say, around a 10-15% of the total contract value as a margin money. So the value is getting derived from the spot market. There will be some initial investment, which is in the form of margin money. And the settlement, of course, is going to be done 6 months later. So this also becomes a derivative instrument as well. I hope, friends, you got your basic understanding on a futures contract as well, right? I hope I'm clear with the futures contract as well. Okay, that's wonderful indeed. Now let's give you an exposure on the third kind of contract. Well, I guess almost since last 1 hour, I've been teaching you more of financial management rather than financial reporting, but all this is given in the study material as well. If you look at one of the units which is dealing with financial instruments, one unit is dealing with derivative contracts. I am indirectly teaching you the derivative parts in advance. Now let's come to the third most common kind of contracts, and that is called an option contract. So let's see what is an option contract with an example. Well, here again, in terms of illustrating the concept of an option contract, let's consider the share market as a base. Now, I'm going to consider two parties in this case, Mr. A and Mr. B. Let's consider individuals, and I am considering shares as a base to explain the concept of an option contract. Well, of course, we are not dealing with individuals, but just to give you a basic understanding of the concept, let's consider two individuals entering into a contract. Now, let's say Mr. A approaches Mr. B today. Mr. A approaches Mr. B today and tells him that I want to buy, let's say, 1000 shares of company XYZ, or let's take it ABC Limited, at the rate of, let's say, 80 rupees per share. So Mr. A approaches Mr. B and tells him that I want to buy 1000 shares of ABC at the rate of 80, but I want to buy this 6 months later. So he approaches Mr. B today. Mind the words, he approaches Mr. B today, but tells him that I am interested to buy these shares at a later date, 6 months later. So he says, I'll pay you this money 6 months later, and I will get the delivery of these shares 6 months later. But let's enter into the contract today. The contract is entered today with a promise to, settle the transactions at the end of 6 months. Now, in this particular case, Mr. A pays a premium. Mr. A pays a premium to Mr. B. Mr. A also pays a premium to Mr. B. Why does he pay this premium? Mr. A pays a premium to Mr. B, which is called an option premium. And this option premium gives Mr. A a right of refusal. Mind the words. Mr. A goes to Mr. B and tells him that I'm going to give you some money, and that is called an option premium, which will give me the right to refuse. He tells Mr. B that after 6 months, if I am interested in buying the shares, I'll buy. But if I'm not interested in buying the shares, I will not buy. So unlike a futures contract, unlike a forward contract where there is no escape, in this case, you can escape. Because you are making a payment of a premium on day one, which gives you the right to escape on the contract. Mr. A, by making a payment of premium, gets the right of refusal. If Mr. A at the end of 6 months feels that I want to buy the shares, he'll buy. If Mr. A feels I don't want to buy the shares, he will say, no, I'm not interested. So in this particular case, Mr. A gets the right of refusal. So by making a payment of premium, we can say Mr. A gets a right to refuse. Mr. A gets the right to refuse. He says the ball is now in my court. If I want to buy the shares, I'll buy. If I don't want to buy the shares, I'll not buy. And Mr. B becomes under an obligation. If Mr. A says, I want to buy the shares, B will say, okay, sir. If Mr. A says, I don't want to buy the shares, Mr. B will say, okay, sir. But this premium which Mr. A pays to Mr. B now belongs to Mr. B. Whether Mr. A exercises to buy or he does not exercise to buy, the premium is already gone to Mr. B, and the premium definitely belongs to Mr. B now in this case. Now let's imagine the position at the end of 6 months. Now let's say 6 months later, the market price of the share. Let's take some variations. Let's say after the period of 6 months, the market price of the share is, let's say, 110. Now imagine what Mr. A is thinking. Mr. A is thinking that I have the right to buy the share at the rate of 80. He's already entered in the contract which A gives him a right to buy the shares at 80, and the price in the market is 110. So he will definitely say that it's a good deal. Let's buy the share from Mr. B at the rate of 80 and then sell the share in the market at 110. You can definitely pocket the gain of 30. Because you've got the right to buy the share at the rate of 80, so you can buy it at 80 and then sell it at 110. So he will say, yes, I want to exercise the option. He will say, yes, I want to exercise the option. And when Mr. A decides to exercise the option, it is in technical words called that it is in money. When he says, yes, I will exercise, it is in technical words called that it is in money. The option is in money. That means I want to exercise. Now let's take another example. Let's say the price of the share drops at the rate of 65. Now Mr. A starts thinking that I have the right to buy the share at 80 and the same share is available in the market at 65. Why should I buy at 80 if the same thing is available in the market at the rate of 65? So he tells Mr. B, sorry, I don't want it. So in this particular case, he will not exercise the option. He will say, I am not interested to exercise the option. Because if the same share is available at the rate of 80, 65, why would he buy? And since Mr. A has already paid a premium, it gives him the right of refusal. He is in a position to tell Mr. B, I am not interested. Unlike a forward or unlike a futures contract, he would say, I'm not interested to buy. And if this is the case, we say it is out of money. Technical terms, we call this that this is out of money. So when he exercises, we say it is in money. And when he says, I don't want to exercise, we say it is out of money. Now let's imagine the price of the share in the market is exactly 80. After the end of 6 months, the price in the market is exactly 80. Now Mr. A will feel indifferent. He will say that I can buy the shares from Mr. B at 80. The same is available in the market at 80. So he says, I'm indifferent to the situation. Whether I exercise or not, it's a no gain, no loss situation to me. So in this particular case, he's totally indifferent. He may or may not exercise. That's his choice. And if it is an indifferent situation, in technical words, it is called at money. In technical words, it is called at money. Which means after the end of 6 months, when A evaluates the position in terms of option, he would start understanding, I want to exercise, it is in money. I don't want to exercise, it is out of money. I'm indifferent, then it is called at money. So accordingly, he may exercise the options or not. And let me also now tell you another technical terms at this stage. In this particular case, when A enters into the contract, to buy the shares, then we technically call this as a call option. When A enters into the contract to buy, so when you say that A pays a premium to buy, it is called a call option. In the same situation, if Mr. A enters into the contract to sell, it is called a put option. So when you enter into a contract to buy, I'm looking at from the person who is paying a premium. So the person who pays the premium, if he enters into the contract to buy, it is called a call option. When he enters into the contract to sell, it is called a put option. So on the contrary, if he would have entered into the contract to sell, we would call this as a put option. So Mr. A who pays a premium, Mr. A who pays a premium, we need to see from his point of view what is the kind of contract he's entering into. If he's entering into a contract to buy, it is called a call option. And if he's entering into a contract to sell, then it is called a put option. And another inputs to you. From Mr. A's point of view, who pays a premium, it is called a long position. From the point of view of Mr. A, who pays a premium, is called a long position. And the person who gets the premium, that is Mr. B, is called a short position. So from the B's point of view, he takes what is called a short position. So let me also clarify another thing as well, because many people at times gets a confusion in this stage as well. Now, when Mr. A pays a premium to Mr. B, I would say it's a long call for A and it's a short call for B, not put, not put. So an option which is a call option is call for A and B both. An option which is a put option is a put option for A and B both. It's only the matter of position. When A pays a premium to buy, long call, and B is a short call. When A pays a premium to sell the shares, then we can say it's a long put, and for B it is a short put. So the position will decide who is under a right and who is under an obligation. So when A pays a premium to buy, it's a long call and it is a short call for B. When A pays a premium to sell, then it's a long put for A and it is a short put for B. At the end of the contract, when A evaluates the agreement, he would say, I want to exercise in money. I don't want to exercise out of money. I'm indifferent to the proposal. It is at money. Let's also add another element as well. Let's say if the price of the share shoots up like anything. Let's say the prices touches to 250 per share. Now, Mr. A will be very keenly interested to buy. Then it is called deeply in money. And if the price of the share goes down badly, let's say it becomes 20 rupees per share, Mr. A is not at all interested to exercise. It is called deeply out of money. So you can have 5 kind of positions at the end of the contract. A is interested to exercise in money, highly interested to exercise deeply in money, not interested to exercise out of money, absolutely not interested to exercise deeply out of money, is indifferent, it is called at money. The 5 kind of positions can be there in terms of a call option and even in terms of a put option. I hope you get the basic understanding of an option contract as well. So we can make a mention that as far as options are concerned, it is again exchange traded. It is again exchange traded. They are not over the counter. Just like a futures contract, they're again exchange traded. They're traded on an exchange. And number 2, there is an escape. Escape is there. Unlike a forward contract, unlike a futures contract, in this case, the escape is there. You are making a payment of a premium. And once you make a payment of a premium, that entitles you that you can push out of the contract. So I think I have given you enough inputs in terms of understanding the 3 features of a derivative contract. What is the most common examples of a derivative? How does a forward work? How does a futures work? How does an option work? I think that working knowledge in terms of these most common kind of derivative contracts is clear. Let me get your thumbs up on that. Are we pretty clear on the concept of derivative instruments, that what are the features of derivative instruments, and the most common kind of examples, the forwards, futures, and options? That's wonderful indeed. Okay, so I think now we can come back. Enough of derivative discussions, enough of financial management discussions. We now need to come back to the financial reporting part. Let's come back on the chain. So I'm just going to remind you what I started off in the morning, and let's come back on the agenda. Let's come back on the agenda. So I said, when you're looking at financial instruments, the instruments could be non-derivative in nature. That means they do not have any element of a derivative. Or we can say that it has got all the three features of a derivative instrument, then it is a derivative. Or the instrument may have a component which is derivative. The instrument is supposed to be a non-derivative instrument, but there is an option which is inserted in the instrument, and that is called embedded derivative. Now, why did I explain you all these things? The moral of the story now comes at this stage. Yesterday, I gave you a version 1, and then I gave you a version 2 of my three-step model. The version number 1 and version number 2. In version number 2, I made changes to the step number 2. And all the discussion, the 3 steps which I've given you, is completely applicable only to a non-derivative contract. Now in version 3, I'm going to change the step number 3. In the version number 3, I'm going to make a changes in step number 3. In step number 3, now I'll give you 2 different kind of test. If it is a derivative contract, a different test will apply. If it is a non-derivative contract, a different test will apply. So I'm now going to give you a third and the final version of the 3-step model, where I'm going to make changes in the step number 3. The step 1 remains the same. The step 2 remains the same. The only change coming in is in terms of the step number 3. Now watch this. So let's now give you the final version of the 3-step model, so you can start noting this down as well. So I am coming back to the 3-step model which I gave you. For deciding the nature of the instrument is FL, equity, or CFI. And for this particular purpose, I am giving you a version 3. I was very impressed with the way, the movie people, the movie makers are making films. They call it as Pushpa, then they call it as Pushpa 2, and then Pushpa 3. I said, why can't we do that in our, daily education exercise as well? We've got the version 1, the version 2, and the version 3. So there is new things coming in each and every version. The version 2 changed the step 2. The version 3 is going to change the step 3. So in terms of version 3, the step 1 and 2 is going to remain the same. No changes. We are not making any changes in terms of step number 2 and 1 and 2, but we are going to change the step number 3. So I'll just give you the changes which is going to happen in terms of the step number 3 as far as the 3-step model is concerned. Now watch this carefully, because I'm going to give you some interesting steps and you will immediately say, so logic. Now coming to the concept of step number 3, your focus in terms of step number 3 was number of share is fixed or variable. Now caution. In step number 2, when you said the mode of payment is equity shares, you come to the step number 3. Now, you need to decide, is the instrument derivative or non-derivative? So in the step number 3, what you need to decide at this stage is the instrument derivative or not? So Now the change in terms of step 3 is you're not going to look at the number right now. You are going to first see that what is the nature of the instrument. You need to see what is the nature of the contract or what is the nature of the instrument. So we need to first of all decide, is it derivative or is it non-derivative in nature? So you will first of all evaluate those 3 parameters which I gave you and decide, is it derivative or is it non-derivative in nature? I think let me put some technical inputs at this stage as well. Let me just add a few more technical inputs at this stage. As I said earlier, it could be a derivative, it could be a non-derivative, or it could be a case of embedded derivative. Now, watch this. If the instrument is non-derivative, you evaluate this parameter. If the instrument is a derivative, you evaluate this parameter. But if the instrument is a blend of derivative and non-derivative, to the component which is derivative in nature, mind the words, to the component which is derivative in nature, you apply this test for the derivative component and you apply this test for the non-derivative component. Oh my God. Which means the instrument which is a blend of a derivative and a non-derivative, you need to segregate the non-derivative component and the derivative component. To the derivative component, you will apply this test, and to the non-derivative component, you will apply this test. Sir, are we going to take an example? Are we going to make a walkthrough on this kind of contracts? Yes. So in this particular case, if it is a non-derivative contract, we will apply a test which is called a fixed test. And if it is a derivative contract, we will apply a test which is called a fixed for a fixed test. The test changes in this particular case. We will apply a test which is called a fixed for a fixed test. Don't get worried on the logic. As of now, I'm just going to tell you what is to be done. Then after a couple of minutes, I'll also give you the logic of the concept as well. So if you say it is a non-derivative contract, I will apply a fixed test. And if it is a derivative contract, the test changes to what is called a fixed for a fixed test. Now, when you say that you are going to apply a fixed test means you need to see, is the number of shares fixed or variable? When you apply a fixed test, it is the same test which you did yesterday. You need to see, is the number of shares fixed or is the number of shares variable? And when you say it is a fixed for a fixed test, then you need to see the number of shares and you also need to see the consideration. You also need to see the consideration as well. So there are 2 words which are fixed. It says fixed for a fixed test. You need to see the number of shares and you also need to see the consideration. So we didn't get that. What do you mean by that? You're going to look at the number as well as the consideration. Let me, I think, now tell you a basic logic of why 2 different tests are there in terms of the 2 kind of instruments. Hear me very carefully. When you look at a non-derivative contract, the consideration has already been received. As an instrument issuer, as an issuer of the instrument, I issued an instrument and I got the consideration. So the only thing which relates to the future is the number of shares to be given on settlement. Mind my words very carefully. I'm giving you the logic of why the standard setters had a different test for a derivative as well as for a non-derivative instrument. If you look at a non-derivative contract, in this particular case, as an issuer, I already received the consideration. So what is now to be decided in the future? The number. Is the number of shares to be given in the future fixed or variable? But if it is a derivative contract, There has been no initial investment. As an issuer of the instrument, I have not received any consideration so far, or I've just received an initial basic net investment. So in this particular case, what is going to be futuristic? The consideration is also futuristic and the number is also futuristic. So in a non-derivative contract, the standard sellers had very one interesting inputs in mind. That when you're looking at the concept of a non-derivative contract, what relates to the future is only the number, not the consideration. But when you're looking at a derivative contract, what relates to the future is both the consideration as well as the number. Did you get my point? Did you get my point very clear that for a non-derivative, what is related to the future is just the number. And what is related to a derivative contract is both the number and the consideration both. Great. So in this particular case, you need to apply what is called a fixed for a fixed test. C is the number of shares to be allotted is fixed. C is the consideration to be received in the future is fixed. If both are fixed, it is equity. If any one or both are variable, then it is a financial liability. So in this particular case, when you apply the fixed test out here, and when you apply the fixed for fixed test out here, we can say, if the number of shares is fixed, it is going to be equity instrument. If the number of shares is going to be variable in nature, then it is going to be financial liability. This is something which we did yesterday as well. But when you are looking at a fixed for a fixed test, if we say both are fixed, the consideration is also fixed, the number is also fixed, then it is equity instrument. And if you say any one or both are variable, any one or both are variable in nature, then in that particular case, it is going to be called as a financial liability. I think let me also give you some more technical inputs at this stage. Sir, since morning, you have been giving us so much technical data. Well, this is just the beginning of financial instruments. You will get a huge knowledge as well. You're going to get wonderful knowledge on this particular topic on financial instruments. One of the pillars, I would say, in terms of indices. So in terms of the fixed for fixed test, we say if both are fixed, it is equity. Any one is variable or both are variable, it is called as financial liability. So if you look at the study material also, they've very clearly given you the permutation combinations of explaining that if you say it is fixed for fixed, equity. If it is fixed for variable, if it is variable for fixed, if it is variable for variable, it is financial liability. Because when I say one element of both elements are variable, it becomes a financial liability. So if this is variable for variable, variable for fixed, fixed for variable, it is financial liability. So when I say any one or both are variable, we are indirectly saying that either it is variable for variable, or it is variable for fixed, or it is fixed for variable, it is FL. If it is fixed for fixed, then it is equity instrument. So we need examples. We now need examples, sir, to understand this in a little more detail. How does the application for a fixed test would apply? Of course, we're going to do that. So let me just consolidate the journey in terms of my three-step models to get the focus very clear. I just want to give you a simple focus points before we proceed further. I want to give you the focus points in terms of the three-step model which I gave you. So we are very, very clear on the conceptual application of this, because now we're going to pick up illustrations in the study material. Maybe we're going to make a little walkthrough on the previous illustrations done, because when we were looking at those illustrations, we never looked at whether it is derivative or non-derivative. I think there is a need to revisit those illustrations and have a look at whether it is a derivative or is it a non-derivative instrument. Of course, wonderful indeed. So let me now first give you some focus points before we proceed further. Let's give you some focus points further. Well, in my three-step model, as I said, that there are certain key focus points, and I want to make the focus points very clear, because when you attack the illustration, when you attack a particular question, your mind needs to be very clear that what are the key features I'm looking at. Well, the first focus is that you're looking at obligation. The second focus is you're looking at the mode of payment. And the third focus is that you're looking at, is it a derivative or is it a non-derivative instrument? So I would say when you're focusing on step number one, your focus point is that you need to first of all zero down on the fact that there is an obligation which is contractual in nature. So you need to first of all see that as an issuer, there is an obligation which is contractual. Your second focus is the mode of payment. Is it cash or is it supposed to be shares? Now, when your mode of payment is supposed to be cash, you need to be very clear. Is it mandatory? Is it discretionary? Is it redeemable or is it irredeemable? And when your focus comes on the irredeemable element, you need to compare the contracted rate and the market rate as well, what we saw yesterday. That when you're considering that it is an irredeemable instrument, you need to see that the interest rate is suppressed or not. Your focus has to be very clear that when you see the focus point is cash, you see the terms mandatory, discretionary, redeemable, irredeemable, and when it becomes irredeemable, then again you start thinking, is the market rate and the contracted rate same or different? Accordingly, you decide, is it FL or is it supposed to be CFI? When the mode of payment is shares, you switch over to the step number 3 and you decide if it is derivative and if it is non-derivative. If it is derivative, you need to apply the fixed for fixed test, F4F, fixed for fixed test. And if it is non-derivative, then it is a fixed test. So your focus needs to be very clear that if the mode of payment is cash, what is the chain of thought? If the mode of payment is shares, derivative, non-derivative, decide the kind of test. So in this particular case, when you focus the question, your mode of payment decides cash, redeemable, irredeemable, mandatory, discretionary, shares, derivative, non-derivative, which test to be applied, fixed or fixed for fixed test, and then accordingly you reach your conclusions. I hope I've made my focus points very clear. I think now we're ready to move on and see some illustrations with you. And we are now going to revisit on the illustrations done earlier as well, because I want to now look into the step number 1, 2, 3 all in detail. Let's get ready. So I am going to take you, we'll come back to some few simple examples later, but I guess let's begin the journey. I guess let's start with the unit number 1. And in unit number 1, I am looking at the illustration number 3. Is this good to watch? Is the size visible, I guess? Though I will need the upper part later maybe. Is this good to watch, I guess? Or I need to zoom it further? Okay, I guess we did a very extensive discussion on this concept last class as well. This is illustration 3 of unit number 1. The word is a perpetual debt instrument. What goes at the back of the mind when you hear the word perpetual? Tell me. The moment you hear the word perpetual, what comes as a focus point in your mind? Sir, contracted rate and market rate comparison. Is it equal then FL? If it is not equal, then CFI, right? That's correct. Let's read. A issues a bond at a principal amount at CU. CU means currency unit per bond. The terms of the bond requires an annual payments in perpetuity at a stated interest rate 8%. That's contracted rate. Assuming 8% to be the market rate of interest for the instrument when it was issued, the issuer assumes a contractual obligation to make a future interest payments with a fair value, a present value of 1,000. I don't think so. I need to explain to you that why does he say the fair value or the present value? I said yesterday that the money raised is called a transaction value, and the liability is taken at initial recognition at a fair value, which is a present value of all the future payments. And he's very clear. He said that the present value of all the future payments is 1,000 on initial recognition. Would you like to tell me, is it equity, is it financial liability, or is it CFI? The contracted rate, the stated rate of interest is 8%. The market rate of interest is 8%. So what is your inputs on that? Let's get the answer. Shoot it from your side. So this is a perpetual instrument. And the moment I look at this perpetual instrument, the contracted rate is equal to the market rate of interest, and that's rightly given. It is undoubtedly a financial liability. Okay, I guess that was the point, and we rightly got the answers on that. Let's go to the next one. So this was unit number 1 illustration I did. I am now going to take you further, and I guess let's consider this. Let me just zoom this further. This is unit 1 again, illustration number 6. We're looking at the illustration number 6 in the unit number 1. Let's have a look. It says Silver issued irredeemable preference shares with a face value of 10 and a premium of 90, and they carry a dividend at 8%, but the dividend is paid only when Silver declares a dividend on equity shares. I'm telling these preference shareholder, I will give you a dividend when I give dividend to those equity shareholder. Dividend to equity shareholder is discretionary. And if you make your dividend also dependent upon that discretionary dividend, then what do you think? Isn't that also discretionary in nature? Yes. So if you look at the principal, it is irredeemable. You look at the dividend, it is discretionary. Would you like to define me the kind of instrument in this case? That's good. It is supposed to be an equity instrument in this case. So you can keep reading the answers out here, but in this case, I am just putting the conclusion. The preference shares meets the definition of equity instruments. I'll not get into the detailed reading of the answer. We know the logics. You can keep reading the answer, but you've got the concept clear. Good. And by the way, we did not see any element of derivatives so far. When I looked at the instruments, I didn't see anything which is derivative in nature. Let's have a look at further inputs, and let's consider this. Let's go to the illustration number 7. So let's have a look at illustration number 7. This is again the unit number 1 of the study material. It says A is investing in compulsorily convertible preference shares. It is called CCPS. It is not option to convert. It is a compulsory conversion. Now please hear me very carefully. If I issue an instrument where I give an option to convert, I would call this as embedded derivative. So the moment you give an instrument, you issue an instrument. For example, my company issues a debenture. I'll say it's a non-derivative instrument. But my company issues a compulsorily convertible debenture. It is still a non-derivative instrument. But when I issue a debenture where I give you an option to convert, we call this as an OCPS practically. This is called a CCPS, compulsorily convertible, that's non-derivative in nature. But when I say it is OCPS, that is optionally convertible preference share, it becomes a third case. That is, there is an embedded derivative. It's not a pure derivative. It's not a pure non-derivative. It's a blend of a derivative and a non-derivative. So be careful when I say it is compulsorily convertible, we are saying it is non-derivative in nature. Let's read further. A invested in compulsorily convertible preference shares issued by the subsidiary. Now, in this particular case, I'm not looking at from the point of view of the investor, because from the point of view of the investor, it is undoubtedly going to be a financial asset. I'm looking at the instrument from the issuer point of view. So it says it is issued by the subsidiary. Under the terms of the instrument, each CCPS is compulsorily convertible into one equity share. What does this mean? One share for every one CCPS. For one CCPS, you are going to give one equity share. What is he hinting at? Is the mode of payment equity shares? Yes. Since it is a non-derivative instrument, you are going to apply the fixed test. When you're going to apply the fixed test, can I say the number is supposed to be already fixed in this particular case? Because when you tell the person that I am going to give you one equity share for every one CCPS, the number is already fixed in nature. Then he says at the end of 5 years, and they carry a dividend at 12%, payable only when declared at the discretion of B. So the principle is in the form of equity shares, where it is a fixed in number. The return, the dividend is purely discretionary in nature. Would you like to tell me what is the nature of the instrument? So we are given that the principal amount is in fixed number of equity shares, a non-derivative instrument where we're applying a fixed test, and the dividend is discretionary. Correct. It becomes an equity instrument in this particular case. So the inputs are given, but I'll just look at this. It meets the definition of equity instruments and it will be classified as such in the books of B Limited. So you can keep reading the details, but I've given you the inputs. Now you can see the moment he tells me that I am going to convert this in terms of equity share, it's compulsorily convertible. I decided it is a non-derivative instrument. And if it is a non-derivative instrument, I decided that I'm applying a fixed test. Had it been a derivative instrument, I would have zeroed down on the fact that it is to be a fixed for fixed test. So when you're looking at the mode of payment equity shares, it is important to first reach a conclusion. Is it a derivative or is it a non-derivative instrument? Accordingly, you zero down on the test and the parameters. Okay, let's look at illustration number 8. Target took a borrowing from Z for 10 lakh rupees and Z enters into an arrangement for settlement of a loan against issue of certain number of equity shares whose value will equal 10 lakhs. And for this purpose, the fair value per share. It says the fair value per share. So I am given the fair value per share. The total number of shares to be issued is based on the market price of the shares at a future date upon settlement of the contract. The mode of payment is again supposed to be shares. Number one, is it a derivative or a non-derivative contract? It is supposed to be a borrowing which is definitely convertible in terms of share. It is again compulsorily convertible in nature. So this is again going to be non-derivative in nature. And if it is non-derivative in nature, we need to apply that mode of payment is shares. And if the mode of payment is shares, we need to apply a fixed test. And if you apply a fixed test in this particular case, what do you say? Is the number variable or fixed? The number of shares to be given is based on the market price at a future date. That means, is the number fixed or is the number variable in nature? The number is definitely variable in nature. And in this particular case, if the number is variable, you can decide it is supposed to be what? A financial liability. That's correct. So in this particular case, we can say, hence the contract meets the definition of financial liability in the books of target. Are you getting a confidence in terms of understanding the application of the three-step model in terms of different permutation combination? Say yes. You must say a yes on that. Okay, wonderful indeed. Let's take it further. This was unit 1. Now we are coming back to the unit number 3. I did this illustration yesterday as well, but when we were looking at this illustration, at that stage, we did not know that there is a fixed test and there is a fix for a fixed test. So I am revisiting on certain illustrations with you to get the concepts very clear. Let's have a look at the illustration 1. So from here onwards, we are starting with the unit number 3. Till now, I was dealing with illustrations which were supposed to be based on unit 1. Now I'm looking at unit number 3 of the study mat. Unit 2 will come later. It says A issues preference shares and the preference shares are redeemable at the end of 10 years and entitles the holder to a cumulative dividend of 15%, and the dividend rate is commensurate with the credit risk profile. Now, let me also ask you a simple question. If the mode of payment is cash, am I concerned whether it is derivative or non-derivative? Yes or no? If your mode of payment is supposed to be cash, am I concerned whether it is a derivative, non-derivative? That's right, no. The concept of the instrument being derivative or non-derivative is going to come into play only when you are looking at the mode of payment as equity share. So if the mode of payment is cash, I'm not concerned. And in this particular case, the mode of payment is supposed to be cash only. So when it says they are redeemable in nature, when it says it is a cumulative dividend, does this mean that this is a financial liability and this is also financial liability? So what is the overall nature of the instrument? Redeemable in nature, FL. Cumulative dividend, that's mandatory, FL. So overall, the instrument is going to become a financial liability. So that's what it says. It is a financial liability in its entirety. Let's take it further. So we did a couple of illustrations here as well. We did illustration 2. I am just going to go back to the illustration 2, 3, and 4 as well. It says X company issues debentures. They are redeemable at the end of 10 years. Interest is payable at the discretion of the issuer and the interest rate is commensurate. The mode of payment is again supposed to be cash. There is no mention in terms of mode of payment being equity share. I am not concerned. It's derivative, non-derivative. So we know that if it is redeemable, it is FL. If it is discretionary, it is equity. So what is the overall nature of the instrument? Very good. It becomes a compound financial instrument in this case. The instrument has got two components. They've made a mention of the compound financial instruments, but discussions have been done on CFI at a later stage. Okay. Now comes the illustration number 3. P takes a loan from Q and the loan is perpetual. Ahaha. The moment you look at the word perpetual, what kind of bell is ringing at the back of the mind? Perpetual. That's right. Wonderful indeed. You need to compare the contracted rate versus the market rate and take a call. I'm only given that the fixed interest rate is 8%. So I am assuming, in the absence, I am assuming that let's say the market rate of interest is also 8%. Then would you like to give a conclusion that what it is going to be? Financial liability. If you say that in this particular case, it is the same rate, which is the market rate, it's a financial liability. So the instrument is FL. I think illustration 4, I've already given you the input. I explained yesterday if there is a lack of access to the foreign currency, Your inability to pay the amount which is due doesn't make the instrument equity in nature. Your inability to access the foreign currency, whatever, that does not make any difference on the classification. So it does not negate the entity's contractual obligation to pay. Great. Okay, now comes the interesting element. Aha. So now we have seen a lot of instruments which are non-derivative. We have hardly seen an example which is coming to be derivative in nature. Yesterday also we stopped at the point of illustration 5, and today also we reached that particular point. Oh my God. Imagine for doing that illustration 5, we have spent almost like another 1.5 hours, 2 hours to reach that grounding work of solving illustration. Right time to give you a break. So I think it's the right time to give you a break at this particular stage to relax your minds. Then we're going to look at this particular illustration. I am also want to make another chart number 4 as well, but that would be after dealing with the concept of what we call optionally convertible preference shares or optionally convertible debentures as well. The chart in terms of a blend of derivative and a non-derivative instruments remains. So let's, I think, first give you a 10-12 minutes break, friends, and then we come back on this particular illustration. So please relax your minds, and I see you in another 10 to 12 minutes time. Enjoy your break. So I hope you had a relaxation of mind. Now I think let's come back to the illustration 5 where we left the trail in terms of discussing the instrument is derivative or non-derivative in nature. Now watch this carefully. The next 10-15 minutes could be a bit heavy. So I think let's have a look at this illustration. Let's go to illustration number 5. It says D issues preference shares to G and the holder has got an option to convert these preference shares to equity instruments of the issuer anytime up to a period of 10 years. Now, when I say it is option to convert, it is OCPS. Now, first of all, let's understand one thing very carefully. If you're looking at an instrument which is a preference share, let's not consider any option. I would say it is a non-derivative instrument. Now, when you introduce the option to convert, it is a case of adding a derivative to a non-derivative instrument, and I would say it becomes a case where there is an embedded derivative. So when you've got OCPS, optionally convertible preference shares, or OCD, that is optionally convertible debentures, where there is an option to convert the instrument, the insertion of the option is adding a derivative element, a derivative component to the instrument, and that would give rise to what we call an embedded derivative in the instrument. Then he says, if the option is not exercised by the holder, the preference shares are redeemed at the end of 10 years. Examine the nature of the financial instrument. Now, before I take the journey forward, in order to solve this particular illustration, I am also now going to give you another story. So let's go for a little story time and tell you the story of 3 people, Mr. A, Mr. B, and C. You need to hear the story very carefully and tell me the analysis of what kind of instruments the company, the issuer, will issue them. So I think I'll come back to this illustration, but before this, let's, give you a little story time. So let me, take the case of 3 individuals. Let's make these 3 people. So let's say we've got Mr. A, let's say we've got Mr. B, and let's say we've got Mr. C. Don't worry, we're working on illustration 5, but I need to first of all give you some basic backgrounds to understand. I'll just change the little facial expressions of Mr. A as well. So let's say as Mr. A is concerned, he is a happy man. And let's consider Mr. B, and Mr. B is, let's say, is got, let's say, sad expressions, and let's kiss Mr. C. The expressions will also be indicative of the kind of decisions he's going to take, and he is without any expressions. I'm now going to give you some inputs. You need to apply your concepts, what you've learned so far, and then we're going to apply these concepts back to the illustration 5. Mr. A approaches a company and he says that I want to invest some money into your company. So remember, he is the investor, not the issuer. He is the holder of the investment. So Mr. A approaches a company and tells him that I want to invest 10 lakh rupees into your company. The company says, okay, you tell us that do you want to take a risk or not? And Mr. A clearly says, I'm not willing to take any kind of risk. He says, I want you that you pay me interest at market terms and you repay my principal money at the end of n number of years. He makes it very clear that as an investor, he is not willing to take any kind of risk. So the features are, he tells the company clearly that I am not willing to take any kind of risk. I need you that you pay me the interest at market terms. And he says very clearly that I also want the principal money back after n number of years. What do you think the company will issue him? What kind of instrument? Will they give him a financial liability or an equity instrument, or are they going to give him a compound financial instrument? Remember, he's not willing to take any kind of risk. If he is not willing to take any kind of risk, what kind of instruments will the company issue him? And that's rightly decided. The company will issue him a financial liability. They will give him an instrument which is, of course, a financial asset for A, but it becomes a financial liability for the company. Because in this particular case, the risk is not on the holder, but the risk is on the issuer. The issuer is liable to pay interest at market terms and also pay the principal, which is redeemable after n number of years. It becomes a case of financial liability. Great. Now let's go to the story of Mr. B. Mr. B also goes to the company. He also says that I want to invest 10 lakh rupees, and the company puts him the same question, that are you willing to take a risk or not? And he says that I am willing to take any kind of risk. For me, returns are important. I am willing to take a risk because no risk means no return, and good risk means a good return. So he says, I am willing to take a risk. What do you think? If he's willing to take a risk, what kind of instruments will the company give him? Will the company tell him that, boss, if you're willing to take a risk, that we can't assure you any kind of fixed returns? We will repay the money only on liquidation, and that also, if anything is left over, you get the money. But we will ensure that we make the share price go up. And if you want to realize your returns at any point of time, you can sell these shares on the stock exchange and you can get your returns as well. So is the company going to issue an instrument which is called, very rightly said, an equity instrument? Great. So I think we can see the two extremes where A is not willing to take a risk, the company takes the risk, then it is a financial liability. Mr. B, who is willing to take a risk, then the risk is completely on the holder and the company issues an equity instrument. I think you can guess what Mr. C is going to be given, but let's tell you the story again. Mr. C also goes to the company, says, I'm willing to invest 10 lakh rupees, and the company puts the same question to him, are you willing to take a risk? Now, Mr. C says that I am willing to take some calculated risk. I am not like Mr. A, who is risk averse. I'm not like Mr. B, who is completely into risk-taking abilities. I am going to take certain calculated risk. I will take a risk, but I'll take certain calculated risk in this particular case. Watch the deal. Company tells Mr. C that, Mr. A, we are paying an interest at the rate of 12%. Mind the words carefully. The company tells Mr. C that to Mr. A, we are paying interest at the rate of 12%, which is the market rate of interest. But we will give you a 10% interest rate. Instead of giving you a 12% rate of interest, we'll give you a 10% rate of interest. He says, why are you giving me a lesser rate of interest? When you're paying a 12% to Mr. A, why a 10% to B? The company tells him that we will give you an option to convert your security in terms of equity shares if you want. They tell him that you can't get your bread buttered on both the sides and eat it too. So they say that we will give you, along with a 10% interest, an option to convert in terms of ordinary share. Mr. C immediately tells him, does this mean that after a period of 5 years, I'll have a complete option to decide that if I want cash, you'll pay me cash? I said, yes. He says, if I want shares at any point of time, you'll give me shares? I said, yes. So he immediately thought that that's a great deal. I am sacrificing 2%. I am sacrificing 2%, but in lieu of that sacrifice of 2%, I am getting the option to convert. If I want cash, I get cash. Now, Mr. A is not getting the option. Mr. A is getting a flat 12% interest and his money will be paid back in cash. But Mr. C sacrifices the 2% interest and he gets that option to convert in lieu of the 2%. Can I indirectly say that the rate of interest is not commensurate to the market rate of interest? Will this lead the instrument to be a compound financial instrument? Say yes or no. Will I be able to conclude in this particular case with the option to convert the interest rate which is payable is not commensurate with the risk profile? In this particular case, the company, the issuer, is some way or the other trying to suppress the liability and paying an interest at the rate of 10% instead of 12%. So would this become a compound financial instrument? That's right. And if it becomes a compound financial instruments along with the option to convert as well, I would say this is also including a derivative as well. I hope you got my point. So I have reached a conclusion generally. I'm saying generally. If the instrument has got an option to convert, one thing is pretty clear, that the interest rate paid on a convertible instrument will always be lesser as compared to the rate of interest which is paid on a non-convertible instrument. If a company lands up paying interest at the rate of 12% on an instrument without a conversion, they'll never pay 12% on a coupon of 12% on an instrument which is with a conversion option. I will definitely pay a lesser interest compared to 12% and because of this option to convert. So two things what comes to my mind. The interest rate is lowered as compared to the market rate, makes the optionally convertible instrument as a CFI. That's one. And the option to convert is also giving you a presence of a derivative in the instrument. So I would say when you consider that it is supposed to be a compound financial instruments with a derivative instruments put together, we can call this as what we call hybrid instruments. This is what we call hybrid instruments, which means my mind is now working on one particular front. A company may have compound financial instruments without a derivative. They are not hybrid instruments. They are basically compound financial instruments in nature. But a company may also issue instruments where there is also an option to convert. In those particular cases, they will become a case of a derivative and a non-derivative. The compound financial instruments without the option is a non-derivative, and the derivative which gets embedded in the instrument makes it a hybrid instrument. Oh my God. Does this mean that I have now reached a conclusion that from the issuer point of view, I'm basically looking at four kinds of instruments? Yes. I'm looking at instruments which is a pure financial liability. I'm looking at instruments which is a pure equity instruments. I'm looking at instruments which is a CFI without any derivative embedded in the instruments. They're non-derivative instruments. And I'm looking at hybrid instruments which has got a derivative element embedded in the compound financial instruments. I hope you got my point. So I am now looking at instruments which are hybrid in nature. They are compound financial instruments, but with the option embedded in those instruments, they become hybrid in nature. Which means now, am I supposed to test this derivative element with a fixed for fixed test? Yes. And am I supposed to test the non-derivative element in terms of the fixed test? Yes. Which means I will only test the derivative component of the instrument by applying the fixed for fixed test and reach a conclusion. Is the derivative component supposed to be a financial liability or is it supposed to be an equity instrument? I hope, friends, I have made myself clear. I am going to apply this concept to illustration 5 as well, but I hope I'm clear with the picture. Okay, let's do one thing before we go back to the illustration 5. I think let's do some more analysis with you and then we come back to the illustration 5. So what my logical mind is now telling me, I am now looking at hybrid instruments. I am now looking at hybrid instruments. Basically, we can say these hybrid instruments are those which are compound financial instruments with an embedded derivative in these instruments. ED is what we are calling it as embedded derivatives in these instruments. So we're looking at instruments which are compound in nature with a derivative embedded, and this embedded derivative is in the nature of option to convert. There is an option to convert, and that option to convert is going to make it as a derivative embedded in the instrument. Now, watch this carefully. The next couple of minutes is also going to be a bit heavy. Then on that basis, I'm going to make a chart 4. Though technically what I'm doing is almost a chart number 4 only. Now, we need to understand one thing which I said yesterday as well. Though we will be learning the art of segregating the compound financial instruments, which I said is called a split accounting. But I just gave you a very basic flavor of a split accounting yesterday, where I said from the proceeds, you need to reduce the financial liability and we get the equity component as a balancing figure. Now, in this particular case, one thing is pretty clear, that when you look at a compound financial instruments, you will segregate the proceeds between financial liability and in terms of equity. The financial liability will be based on the present value of future payments. As I gave you the inputs yesterday, in terms of the split accounting, what you will do, you will consider the present value of future payments into account. So when you consider the present value of future payments, you will get the financial liability, and the equity is considered at a balancing figure. The proceeds are taken, and that is split in terms of financial liability and equity. Now, since there is an option to convert, we are going to test this option to convert by applying a fixed for a fixed test. Now watch this carefully. Since it is an option to convert, we need to apply a fixed for fixed test to decide, is this derivative supposed to be a equity or a financial liability? Now imagine when you apply a fixed for a fixed test and this test passes, or this test fails. Passes means that the consideration and the number both is fixed. Fails means that the consideration or the number, any one or both, are variable in nature. Now, if you pass the fixed for fixed test, then this is going to be called as equity, and if it fails, it's going to be called as a financial liability. Now, hear me clear. Now, logics will become clearer more later when we consider the discussion on embedded derivatives, but hear me clear. If you decide that the option to convert, which is a derivative, if you decide that the option to convert is a derivative and that passes the fixed for fixed test, it becomes an equity. There is no need to segregate this derivative. There is no need to segregate the derivative. The balancing figure automatically will contain this particular derivative element. Now, why don't we segregate that? We'll see more details. But if the derivative is got equity characteristics, the standard Ind AS 109 does not require you to segregate the derivative component of the instrument. But if you say that the derivative meets the financial liability element, we need to definitely segregate this element. We need to go to the valuer and we need to tell him that, please, tell me that out of the proceeds. Now hear this carefully. I'm going to go to the valuer and I'm going to tell him that, boss, please tell me what is the derivative financial liability of the instrument, what is the non-derivative financial liability of the instrument, and what is the equity. The compound financial instruments will be split into 3 parts. I know what I'm saying is very technical indeed. So I will go to the valuers and I'll tell him that, boss, please segregate the derivative financial liability, and there is a non-derivative financial liability and also equity. So basically, let me put it like this. In terms of a hybrid instrument, you need to test this derivative for a fixed for fixed test. If the fixed for fixed test passes, I will segregate only 2 elements of the contract. One is the non-derivative FL and the equity. If the derivative element fails the fixed for a fixed test, I will segregate three elements of this hybrid contract: the derivative financial liability, the non-derivative financial liability, and also the equity component. Let me pen this down. So, moral of the story. The moral of the story in this particular case is, in terms of hybrid instruments, this is practically my chart number 4. So I am looking at the chart number 4. And in terms of the chart number 4, I'm looking at hybrid instruments. My chart number 1 was non-derivative instruments paid in cash. The chart number 2 was non-derivative instruments paid in shares. The chart number 3 is non-derivative instruments paid in shares and cash. My chart number 4 is instruments which are hybrid in nature, derivative and non-derivative in nature. In this particular case, what you need to do, the fixed for a fixed test is evaluated. You will evaluate the fixed for a fixed test. And in this particular case, after evaluating the fixed for fixed test, if the test passes or if the test fails, what are the various elements of the instrument to be segregated? I will segregate if the test passes. The derivative is not to be segregated as per the standard. If you pass the fixed for a fixed test, the derivative is not to be segregated. You will segregate the financial liability non-derivative element, and you will only calculate the equity as a balancing figure. If you fail this particular test, you will have to segregate the financial liability non-derivative element. You'll have to segregate the financial liability derivative element and consider equity as a balancing figure. This segregation in a practical world is going to be done by a valuer, because the valuation of the derivative is going to be done using what we call a Black-Scholes model, and he will be able to tell you that what is the value of the option. So we can say that in case of a hybrid instruments, when the derivative test fails, that means the derivative is a financial liability, you need to split the proceeds of the instruments in three elements: financial liability non-derivative element, financial liability derivative element, and equity component. But in a situation where this derivative test, that is a fixed for fixed test, passes, the need to segregate a derivative element is not required, and for which more detailed insights of logics are available in the embedded derivative section of Index 109. As of now, just keep this in mind. If you pass the fixed for fixed test, 2 elements are segregated, and if you fail, 3 elements are segregated. I hope, friends, I made some sense, though I know what I've spoken so far is highly technical in nature. I think I want to come back to now the illustration 5, and now we are ready to attack this illustration as well. Let's have a look at this illustration again. D issues preference shares to G. The holder has got an option to convert and into equity instruments anytime after 10 years. If the option is not exercised, then it's redeemed at 10 years. It's an optionally convertible preference share. So what immediately comes to my mind is, okay, this is a non-derivative and a derivative instrument combined. It is definitely a hybrid instrument in nature. The moment I see it is optionally convertible, what comes to my mind is that the interest rate given on this particular optionally convertible instrument will definitely be lesser as compared to a non-convertible instrument. So this is going to be a non-derivative instrument, which is a CFI, and there is a derivative element. Now everything depends upon whether you fail or pass the fixed for fixed test. Let's have a look. The instrument has got 2 components: the contractual obligation that is conditional on the holder, whether he wants to redeem or not, and the conversion option. The first component, they've given the answer only with reference to the first component, that it is a financial liability. But you can see in the section on compound financial instruments, we'll analyze the other component, the conversion option, which will explain the instrument in entirety. But I've already explained to you at this stage itself that this is a hybrid instrument. And if it is a hybrid instrument, then in this particular case, three elements will take place. I will now take you directly to another illustration, which is nothing but the same as illustration 5, which is discussed in the study material in the compound financial instrument section. Let's do one thing. Let's, I think, take this further, and we're going to look at the inputs. Okay, before that, let's also have a look at more illustrations which we saw yesterday. So in between, I'm just taking you to more illustrations as well. We saw illustration 13, 14 yesterday as well. Just to be on a very safe side, I just want to show you something so you decide it's derivative or non-derivative in nature. CBA issues a convertible debenture. My piece of advice, friends, is when you look at a convertible debenture, don't immediately run to the conclusion that it is hybrid in nature. It depends that it is compulsorily convertible or is it optionally convertible, and that would decide the fate. I've already said earlier that if it is a compulsorily convertible, it's non-derivative in nature. And if it is optionally convertible, then there is a derivative in nature. Now, I want to read the language and give you a question. You tell me, is it derivative or non-derivative? CBA issues convertible debentures for 100 crores and the debentures are convertible. Please tell me, if I say they are convertible, what do you think? Is it optionally convertible or is it mandatorily convertible? Yesterday, I did this illustration. I did not lay a stress on the word are convertible in nature. So what do you think? Is it mandatorily convertible? That's right. It is supposed to be a compulsorily convertible, a mandatorily convertible debenture. So when it says they are convertible, it means it is mandatory conversion. And if it is mandatory conversion, it is non-derivative in nature. By the way, if the mode of payment is equity shares, then in those particular cases, which test are we applying? Fixed test. If it is non-derivative in nature, you need to apply the fixed test in this case. Yesterday, we learned only about the fixed test. But today we know that there is a fixed test and there is a fix for a fixed test, which means the moral of the story. You need to be clear that since it is a non-derivative contract, we are applying a fixed test, only checking that the number is fixed in nature. So when you see that it's divided by the fair value on the date of conversion, when you divide it by the fair value on the date of conversion, that means the number of shares to be given is variable in nature. And if the number of shares given is variable in nature, undoubtedly it becomes a financial liability. So this instrument becomes FL in nature. I wanted to revisit on this because now you know the entire concept. Now what you need to do, friends, today, before the next class today itself, you need to revise all these illustrations I've done with you, apply the three-step models and evaluate each and every illustration in this case.
Yes, sir.
Okay, let's take it further. And there is another thing as well. In the study mat, you'll also see a couple of illustrations which are given, which I call them as advanced problems on the application of fixed for fixed test. So you need to do those illustrations as well. There are a couple of, I think, 7, 8 illustrations. Beautiful illustrations, though in the exam, that kind of level I have not seen yet. But I guess if you do those illustrations, you'll definitely get a good confidence in that. Okay, so in this particular case, it is a financial liability. So I guess I'll just read the net answer right now. And it's just given, it is a financial liability. Okay, let's go to the illustration 14 as well. It says DF issues convertible debentures for 100 crores and these debentures are convertible. What is going at the back of your mind? It says they are convertible. If I say they are convertible, again, it indicates what? Wonderful indeed. It is mandatory conversion. And if it is mandatory conversion, it is non-derivative. If it is non-derivative, I am going to apply the fixed test in this case. And I guess if I read it further, I get the inputs in this particular case. We are going to issue 15 crore shares, which means the number of share is fixed in nature. And I guess we can undoubtedly decide that it becomes equity instrument in nature. Wow. We did these two illustrations yesterday, but I wanted to revisit on these illustrations to make it very clear that this is not a case of optionally convertible instrument, but compulsorily convertible in nature. Aha. Let's go further. Okay, now I think we can also have a look further on this, because we've seen a couple of non-derivative instruments and we saw a little blend of embedded derivative. Now let's have a look at illustration number 15 and let's see what kind of instrument are we talking in this particular case. It says ST purchases an option. He is simply buying an option contract. Is it a derivative or is it a blend of a derivative, non-derivative? We've seen questions, non-derivatives, hybrid. What do you say? Is it derivative or non-derivative in nature? ST purchases an option. That's right. Wonderful indeed. It is purely derivative in nature. This is 100% derivative in nature. So it says ST purchases an option from AT entitling the holder to subscribe for a fixed number of equity share at a fixed exercise price. Fixed number of equity shares, it says for a fixed exercise price at any time during the period. Yes, I'm getting some answer. Yes, you can tell me, is it equity? Is it financial liability? We're applying a fix for a fixed test.
Equity.
Wonderful indeed. Since we know the number is fixed and since we know the price, the consideration is also fixed. So when you say it is derivative, you apply the fixed for a fixed test. And in this particular case, we can say the consideration, that is the exercise price in the given case, is fixed. We can also see that the number of shares which will be allotted against the consideration is also fixed in nature. And therefore, the conclusion is that it is equity instrument. Wow. This was the first illustration we have done today, which is on a pure derivative instrument. As I started my discussions in the morning, I said it is non-derivative derivative. You can do one wonderful exercise back home today. Because, of course, everything I can't do, you also need to put in your own efforts as well. Make an interesting chart. Segregate the instruments are derivative, non-derivative, and hybrid in nature. Map up the illustrations and map up which illustration relates to which chart. Trust me, it's going to be a wonderful exercise which will help you to revise your concepts very well. You would know that these are non-derivative instruments, illustrations. These are derivative instruments, illustrations. These are embedded derivative kind of situations, illustrations. Get the mapping done. Okay, so that was illustration 15, a pure derivative instrument. This is on the carve-out, which we'll discuss later. Okay, now, illustration 5, we did not complete the answer. I said I'm going to take you back on the compound financial instruments to see the results as well. So I guess let me just come back to the illustration. Yes, this is it. And the reference is already given in the study mat. I sincerely feel, this is one of the best materials I've seen. And I'm not saying because I'm teaching on the ICAI platform, but this really comes from my heart that, the kind of material which has been developed for the student community is brilliant indeed. Because if you notice the kind of inputs, the efforts, they've been put in, mapping the illustration 5 with illustration 27, they're trying to give all the inputs connected. And I think with the inputs you're getting in the classes and you combine the study material, the level of conceptual knowledge you can get is going to be totally unmatched in nature. Not only at the student level, but also as a professional, you are going to get a very good knowledge indeed. I really thank Institute from naturally my heart. It's a real good initiative for the generation, for the budding chartered accountants, the kind of material. Everything is available to you as a free resource. Sometimes I envy all you people. I feel I qualified at a point of time when so much resources were not available. And I passed my CA exams at a point of time when the result was barely around 1.5%. And now I envy all the young budding chartered accountants. You've got huge passing percentage of results. You've got resources to watch classes. You've got resources like this, colorful study materials and all. Wow, that's great. Okay, let's come back on the illustration number 27. So do take good advantage of all these resources and make the best possible use of all what you can do. Okay, so we are back on the concept of optionally convertible preference shares. The same illustration 5 continued. It says D issued preference shares. The holder has got the option to convert. And if the option is not exercised, then you can redeem at the end of 10 years. Now let's see what is the entire detail inputs given. It says the instrument has got 2 components. But before this, I will also like to show you this, that such an instrument is called a hybrid instrument, which I've already said. Thank you, Jyoti, for that. So in this particular case, such instrument is called an hybrid instrument. It says the instrument has got 2 components: contractual obligation that is conditional on the holder exercising the right to redeem, and the conversion option with the holder. The first component is a financial liability because the entity does not have an unconditional right to avoid delivering cash, because the right to convert is with the holder. Therefore, in this particular case, the issuer is under an obligation to pay cash. The holder says, give me cash, I'll have to pay cash. The holder says, give me shares, I'll have to give shares. So as an issuer, I am under an unavoidable obligation, unconditional obligation to deliver cash. That makes it a financial liability. The other component, that is the conversion option, is an equity feature if the fix for fixed test is met. See what clearly it says. The derivative embedded in the instrument, that is supposed to be the option. If it is meeting the fix for fixed test, it's an equity feature. And if the conversion option does not fulfill the test, then in that particular case, it's a derivative liability. And such instruments are called hybrid instruments in nature. So very clearly indicated that this derivative embedded in the instrument is to be evaluated for the 2 elements. If you say that in this particular case, the fix for fixed test is met, it is equity, derivative will not be segregated. And if you say that it is supposed to be a financial liability, derivative will be segregated as well. Okay, so this is, I think, 1 inputs done. Okay. I am now interested in further inputs as well. They've extended that illustration also. Okay, that I think we can see later. So let's do one thing. I am now interested in making a very interesting chart at this stage. I guess it's important for me to, do a little, combined mind map also at this stage. I'm sure you will also feel a need, because as we are progressing, new things are coming in. And I think I'm sure you would now like to look at a consolidation in terms of how your approach is going to be. So I'm going to make a simple, quick little mind map on the consolidation before I take you to the other inputs as well. Let's begin the journey. But I think before we go ahead, I generally have a little habit of asking people to do a self-assessment as well. May I take the liberty of those who are connected out here through the Zoom link out here, why don't you give yourself a comfort zone on a scale of 10 regarding your understanding on the concept of instruments from the issuer perspective? I'll do the mind mapping on that. So let's get your comfort zones on a scale of 10. What is your comfort zone on a scale of 10 regarding the concept of financial instruments so far? We have just completed almost a a tip of the iceberg on financial instruments so far. Okay, I get the very first score. That's 9.5 by 10. That's very encouraging indeed. Superb. The other score is coming to be 10. Wow. That's wonderful indeed. So I think that's great. I got two scores, 9.5 and 10. Another one also getting 10. Superb. So once you make your revisions, the score will never ever go down. Trust me. So let's make a little mind map at this stage. Let me just consolidate the inputs. Watch this carefully. As we discuss this agenda, you are going to get a full level of consolidation on this. So I am considering a little consolidation of the concept, what I've discussed with you, the key focus points. Watch this carefully. You can extend this mind map and map up the illustrations also at a later stage. My mind is now working on the, I don't need the circle. My mind is now working in terms of looking at the instruments from the issuer perspective. I'm looking at the instrument from the issuer point of view. So when I look at the instrument from the issuer point of view, my mind is working on that. I guess there are four kind of instruments. Why I'm saying four kind of instruments? Because I am looking at equity instruments. I am looking at financial liability. I am looking at compound financial instruments without any derivative. And I'm also looking at hybrid kind of instruments. So we can say, and trust me, if you technically ask me a little more advanced, I would say there are basically five kind of instruments from the issuer point of view. You can have an instrument which is a pure equity. You can have an instrument which is a pure FL. You can have an instrument which is a compound financial instruments, non-derivative. You can have a hybrid instrument, and there is another instrument which is called a deemed equity instruments. Oh my God. I don't want to talk about deemed equity instruments at the moment, but in the study material, there has been an extensive discussions on the concept of deemed equity instruments as well. When the company is got various kinds of instruments, but none of them is a pure equity instruments, then the concept of a deemed equity instruments also arises. So as an issuer, if you technically ask me, I would say there can be five kinds of instruments from the issuer point of view. It could be a pure equity instrument. It could be a pure financial liability. It could be a compound financial instruments, non-derivative. It could be a hybrid instruments, and it could be a deemed equity instruments as well, where there is a guidance given in para number 16A and 16B of the standard, which illustrates the kind of conditions which you need to meet. Let's not discuss that at this stage. So let's, I think, divide this into four parts. So from the issuer point of view, we can have, I would say, equity instruments, non-derivative in nature. We can have financial liability, which is again non-derivative in nature. And we can have compound financial instruments, which is again non-derivative in nature. Or we can have what we call hybrid instruments. We can have what is called hybrid instruments, and these hybrid instruments are the one which is a non-derivative plus a derivative instruments into account. So now let's give you some key focus in terms of these kind of instruments. When you're looking at an equity instruments, I would say in terms of equity instruments, when you're looking at that they are pure equity instruments, we can say either they will be instruments where there is no obligation, or we can say no, I would rather put it as there is no unavoidable obligation. There is no unavoidable obligation to pay cash. There is no unavoidable obligation to pay cash. So if I look at an instrument which is non-derivative and I say there is no unavoidable obligation to pay cash, it's purely discretionary. I may pay a dividends, but I don't have unavoidable obligations to pay. So if there is no unavoidable obligations to pay cash, and then we can say that they could be instruments which are going to pass the fixed test. They are instruments which are going to pass the fixed test, which means the number of shares to be issued is fixed. The number of shares to be issued is supposed to be fixed in nature. So in this particular case, the number of shares to be issued is fixed in this particular case. So these are the kind of instruments which we will call them as equity instruments in nature. Let's look at the other one, that is a case where it is a financial liability. Can I say in terms of instruments which are financial liability in nature, I would say there is an unavoidable obligation to pay cash. Because when you are saying that the mode of payment is cash, there is an unavoidable obligation, redeemable in nature, mandatory returns to be given. So what is the key essence is that there is an unavoidable obligation to pay. There is an unavoidable obligation to pay cash. So I'm considering both the modes of payment, whether it is shares or whether it is cash. So here also I've taken cash, here also I've taken shares, here also I've taken cash. And the second one is when you fail the fixed test. When you fail the fixed test in this particular case. And when you fail the fixed test in this particular case, I would say in those particular cases, the number of shares is variable in nature. So the number of shares to be issued, is variable. The number of shares to be issued is variable in nature. Then in this particular case, we can say it's a financial liability. So you can see one thing very clear, that when the instrument is non-derivative, I'm applying the fixed test. When it is non-derivative, I'm applying the fixed test. The concept of fixed for a fixed test does not come into play. Then comes the compound financial instruments, and in terms of compound financial instruments, we can say that this is including two elements. This includes, you can say, two components in this particular case. You can say one of the component is a financial liability and the other component is supposed to be equity. So at this stage also, let me try to pinpoint one more thing. Your perpetual instruments could be, a FL or a compound financial instruments. But let me tell you, compound financial instruments can also be of various kinds. A perpetual instrument could be compound. Even a non-derivative instruments could be compound because you have one component principal as equity, another component is supposed to be FL. So in terms of compound financial instruments also, I'll give you a chain of thought, which is, what kind of instruments could get into compound. So let's do one thing. Let's, I think, give you a little more detail insight at this stage. I'll do the extension shortly. Now let's come to the concept of hybrid instruments. And in terms of hybrid instruments, I can say the derivative is to be tested. It is to be tested for fixed test. So I'm not looking at the non-derivative portions. The non-derivative portions could be FL. The non-derivative portions could be FL plus equity, whatever. So I'm focusing only on the derivative element, that this derivative element is to be tested for the fixed test. And you can say if this passes, do not segregate the derivative. And if you fail, then we segregate the derivative. Then there is a need to segregate the derivative. So which means in terms of hybrid instruments, we need to be clear, when do you segregate the derivative element and when you don't segregate the derivative element. If the derivative meets the fixed test, no need to segregate the derivative element. It is only when it fails the test, then the derivative element of financial liability is segregated. Okay, so now I think let's do a little more discussions on compound. Now my chain of thought is going to be working on compound. So I'll take the last 10 minutes more to just give you some basics on compound. In the next session, of course, I'll do a little extensive discussions on compound. We'll spend almost the entire session in the next class on the discussions on the compound financial instruments, which could be derivative or which could be non-derivative or hybrid in nature. How do you do the split accounting? And what happens as a special feature if there is early conversions of these instruments, because the option to convert can be exercised at any point of time. So we're going to devote a good time on the concept of compound financial instruments with you. But let's, I think, kick off the details. So let's, I think, come back on this particular segregation, that is compound financial instruments. So we can do an extensive discussions in the next class on this area. So I think at this stage, let's talk a little more detail on the compound financial instruments, what we call CFI. Let's see the various kind of combinations which can arise. I'm just going to take a few examples and take you to the illustration in the study material as well on the section of compound financial instruments, just to get a flavor of what kind of instruments can be compound in nature. I basically want to give you three kind of instruments which are compound in nature. So let's first give you the concept, and then we'll go back and have a look at the illustrations in the study mat. So I am looking into three kind of instruments which will generally invariably become compound in nature. So that when you look at an illustration, the mind starts working that yes, this is one of the parameters. I would say when you look at a perpetual instrument, an instrument which is perpetual debt, generally a case of perpetual debt. So the main feature what you need to work through in this particular case is you need to compare what is the contracted rate versus the market rate. Rather, let me put it like this. I need to compare the CR versus the MR. So let me put it, CR is the contracted, or you can say the coupon rate. It is the contracted, or we can say the coupon rate. And MR is supposed to be what we can say is the market rate. So I'm looking at the comparison of the coupon rate as well as the market rate. And let me ask you the question again, which you're already aware. When you compare the two and you get the insights that CR is equal to MR, what are you going to call the instrument as? If the CR and the MR is same, that's right, it becomes a financial liability. And when the CR is not equal to MR, and of course you will notice that CR will be less than the MR, then in that particular case, it becomes what? A CFI. So this will become a case of compound financial instrument. So this is one category of instruments where you're going to see that the instrument becomes compound in nature, but it is non-derivative in nature. This perpetual instrument is again non-derivative in nature. It's not derivative. It is a non-derivative instrument which becomes a compound on the basis of the interest rate equal lesser comparison. Next, I'm looking at another kind of instruments where the return and the principal is paid in different modes of payment. Let's consider that the return is paid in the form of cash and the principal is paid in the form of shares. So let me just remind you the permutation combination. If you remember the chart which I did yesterday with you, I gave you the permutation combinations that if it is mandatory and it is fixed, or if it is discretionary and if it is supposed to be variable. Can I say these are the only two combinations where the instrument becomes compound? Because if it is mandatory and variable, then it is FL. If it is discretionary and fixed, then it is equity. So I would say these are the two permutation combinations when such an instrument is going to become compound in nature. The principal money or the return money, one of the element becomes FL and one of the element becomes equity. It becomes a case of a CFI. And trust me, even this kind of instrument is non-derivative in nature. And finally, we've got another kind of instruments, can I say, which are optionally convertible. They are supposed to be optionally convertible instruments in nature. So when you look at optionally convertible instruments, this can be another area, which means that these are hybrid instruments, compound in nature. You will certainly notice in this particular case that the interest rate, the observation in this case will be that the interest rate on non-convertible debentures will be greater as compared to the interest rate on convertible debentures for sure. You will notice one observation in these kind of questions: the interest rate on NCD, non-convertible debentures, will always be greater as compared to the interest on a convertible debenture, which indicates that there is a suppression of a liability, and that would indicate compound financial instruments, and they will be nothing but hybrid instruments in nature. A combination of a non-derivative and a derivative elements put together. So I think time to show you some examples of these illustrations as well. I have now started my journey in terms of entering the gateway of compound financial instruments to do a deeper discussions on the area of CFI. Let's take it further, friends, and let's, I think, go back to the study material, unit number 3. So I'm just going to come back to the unit number 3 to show you more inputs on a compound financial instruments. Okay, so let's have a look at these two illustrations to begin with. There is an illustration number 25, and we're looking at illustration number 26, and you can again see some interesting features out here. Continued from illustration 3, continued from illustration number 2. Because when you are looking at the initial illustrations, the concept has been built slowly and steadily. So the mapping is again done in terms of illustration. Let's have a look. It says company issues a debenture and the debentures are redeemable. At the end of 10 years, interest is payable at the discretion of the issuer and the interest rate is commensurate with the credit risk profile of the issuer. Would you like to tell me, out of the 3 blocks which I gave you, one is perpetual, one is return principal, and one is hybrid, which case is this? Just evaluate and see which case do you think it is. You're looking at the concept of perpetual, then principal return, then hybrid in nature. Which one do you want to map up with this one? Can I say it gets mapped with the second one? It gets mapped with the second one, the principal and the interest. One of the components is there. So this is redeemable. Rather, I think I'll just like to go back and also add some more inputs. Redeemable means FL, discretionary means it is equity, so it becomes a compound financial instrument. In fact, I could have added out there as well another combination. I'll come back to this slide. Let me just add on more combinations further. Least we forget, I'm just going to add more combinations in this case. So let's add some more inputs at this stage as well. So we can add another combination C and D as well. This is mandatory and this is irredeemable. Or this is discretionary and this is redeemable. I guess we can add more combinations. So all these permutation combinations will create the concept of a compound financial instruments as well. So let me go back to the illustration once again. So I guess now we can clearly see in this particular illustration that in this particular case, it is redeemable. That makes it FL, discretionary makes it equity. Therefore, it becomes a compound financial instruments. That's what the conclusion is given. It is supposed to be a CFI. Let's see further. Illustration number 26, perpetual loan. The company takes a loan and the loan is perpetual and entitles a fixed rate of interest. Examine the nature of the instrument. Out of the three blocks I gave you, perpetual, return principal and hybrid, which is this particular case? Can I say this is a case where we can say is the first one? I need to compare the contracted rate and the market rate and then decide, is it a financial liability or is it equity in nature? And I guess we can just add on and see. So in this particular case, it is a compound financial instruments. I would say in this particular case, we are comparing if the CR is less than the MR, then in that particular case, it is undoubtedly a compound financial instruments. And I think needless to make a mention, I've already covered illustration number 27, which you can see is the third case, which is a case of a hybrid instruments in this case. It is a case of an hybrid instruments in this case. Now you can see in the compound financial instruments, all three kinds of compound financial instruments are discussed. Perpetual instruments, non-derivative. The money of return and principal is paid in two different modes, and that becomes a second case, and the hybrid instruments, which is derivative, non-derivative. So these three illustrations mapped. And then, of course, the calculation of the split accountings has been done. So first, the broader concept of a CFI is done, and then comes the picture where the split accounting takes place. So what am I going to do in the next class with you is going to be very interesting. These three kinds of compound financial instruments will learn the art of segregating the equity and the financial liability. We'll learn the art of segregating the FL equity for perpetual debt instruments. We'll look at the initial and subsequent accounting. We'll look at the concept of, the second category of instruments from the initial to the subsequent accounting. We'll look at A to Z, the accounting for different kinds of instruments. Because I, in the next class, also want to introduce you to the concept of what is called SOKI. My objective of a compound financial instruments is also to give you an exposure on SOKI. So next class, you're going to get more flavor on the accounting part and a good understanding of the SOKI. After that, we are also going to go forward and try to understand more of the concept of other comprehensive income as we progress further. Okay, I think that seems to be quite good for the day. I'm sure your minds must be feeling heavy. But as I requested earlier, what you need to do, friends, is a cumulative revision of this topic. The first class over, you revised. The second class over. Now you revise the first and the second one put together and keep consolidating your revisions. Okay, so any questions? So can you share your notes to the portal? I've already done that. I've already uploaded the notes on the portal yesterday itself. I do it immediately after the class, so even today notes will be uploaded. No worries on that. Right, friends. So I think that's it for the day. If you've got any questions, otherwise I think we're done for the day. So I will be joining you on Tuesday for the further journey as well. Thank you very much indeed. Excellent reasoning and logic. Will remember the dream also. Wonderful indeed, Pooja. That makes my day as well. So thank you very much. And I'll join you back on Tuesday, friends. Thank you. Bye-bye and take care.
Thank you, sir.
Thank you. Anji.